Hi, it's Michael. Again here, it's Tuesday, March 3rd, 2015. I'm here in Scottsdale, Arizona. I need to give you a disclaimer. I am not a licensed stock and bond dealer, nor am I a licensed financial advisor. I am, however, a real estate broker here in the state of Arizona, working for realty executives for over 30 years. So I've done an awful lot of real estate transactions, doing an awful lot of investments for clients and for myself. A couple things have come to pass in the last 24 hours I just needed to maybe discuss with you. A good friend of mine, Mel, told me yesterday that when you hear the train coming, it's time to get off the tracks. Well, you know, I'm hearing a whistle, and I'm not so sure it's a factory shift change. I think it's probably the train coming down the tracks. Goldman Sachs came out with their global indicators. They have proprietary indicators, and it's showing that the world is in contraction for the first time since 2011. They also had, of the proprietary mix, they had 42 misses and only 6 exceed their expectations. And we're talking about personal spending, construction spending, factory orders, domestic vehicle sales, ADP employment, labor market conditions, retail sales, Bloomberg consumer comfort, and the list goes on and on and on and on. These are lower than what they thought they were going to be, and it shows that we're in construction. Also yesterday, Chicago, the city of Chicago's bond rating got lowered to almost junk. It's down to Baa2, and the business barometer from Chicago plunged 13.6 points down to 45.8. That's a pretty stunning drop. Nobody expected that. So it tells me that we need to be very careful. It tells me that things are not perhaps as rosy as what we think they are. And of course, we're all in an economically sensitive business, and people need to really pay attention. Now, employment is still growing, but employment is a lagging indicator. In the last terrible recession, we were actually gaining jobs as we started to fall off a cliff. So that's probably what's happening now too. So we just have to be aware of what's going on. Yesterday we talked about talking to a financial advisor to maybe talk about an exit strategy, maybe taking some things off the table, maybe taking a third. Remember last time, now, you know, I've been in business since 1972, so I've seen an awful lot of recessions. This feels an awful like we're coming into a recession to me. So I'm going to say, you know, we have a recession perhaps on the horizon, and we just need to prepare for that. You know, if you're in the stock and bond market in historical highs, I would say to you that you really need to discuss with someone and just see if maybe it isn't such a good thing to take a little bit of profits off the table. Now, here's what I'm going to suggest, and it's going to seem like it's self-aggrandizement here, but I think that I had planned to do a series of how to create a money machine. I think it's becoming imperative that we start thinking about getting some kind of income. In the last downturn, I had properties. The only thing that really made my life a whole lot better was the fact I had income coming in absolutely every single month. You know, we had some decline in the prices of these properties, and that may very well happen. And some of the rents went down, but nowhere near as severe as some of the overvalued prices plummeted. But income really did not, and that money just kept coming in month after month after month after month. Now, I would suggest to you that I think prices may contract a little bit, and you're going to say, well, why wouldn't I wait to do that? Because if you do that, you're not going to have the income that's going to be afforded now, and you're not going to have the ability to put financing on a property. If you recall, when things get tough, nobody wants to lend you any money, and we have historically low interest rates. I personally am so bullish. You know, I sound like I'm a bear. People say, oh, you're doom and gloom. Well, really I'm not. I just think that we've got a couple of tough years coming through, and then by the time we get 3 to 5 years from now, I just think we're going to be in a boom. I think we're going to be, I think the economy is going to come around. I think we're going to have full employment, and I think we're going to have prices of our properties are just going to skyrocket. So, you know, I follow Walter Zimmerman with IPEC. I mean, he's a brilliant man. He and I have talked about some things, and we think that, actually he thinks that we are in a real estate bull market, and we may very well have a small correction, but it is a correction within a bull market. So I would say to you, you perhaps maybe need to change your mindset just a little bit and start thinking, I am going to become an income investor, not necessarily a price investor, because what we want to do is create a money machine for you. So I would say to you, it becomes very imperative at this point that you start looking and start thinking that maybe I need to scale some of my profits out. I need to balance my portfolio, and I think you probably need to consider putting some real estate income properties into your portfolio. And you know, there are many ways that you can take your IRA and your Keogh money and put some real estate in it, some real estate that you personally own and that you have your name that you can control. Now, typically we wouldn't say to put real estate inside of an IRA or a Keogh account because they're a tax-advantaged investment. But in this instance, the asset class, I'm just expecting the asset class to do really, really well. And probably a little exposure within your Keogh or your IRA wouldn't be at all that bad. But if your personal money, I'd like to see you take a third of your money, talk to your advisor, take a third of your money, and let's deploy it. And probably want to put a little bit of leverage on it, get a mortgage, maybe 50 to 60%, be very, very conservative, because we are looking for cash flow. And I think if you put a 4 or 5% mortgage on a property now, remember, we're extremely long-term investors. In 5, 6, 7 years from now, a 5% mortgage probably going to look like a gift. So I'm really advising that you do that. I think we have some tough times coming here. We just take a look at my notes. I think that there's lots of indicators going. Not only do we have the Goldman Sachs indicator, the proprietary long-term global indicator going off, but Economic Cycle Research Institute, which I follow a lot, their growth rate is down to a negative 4.5%. Subprime auto loans, the annualized net losses have risen 4.5% month over month to 8.19%, which is the highest since 2009. You couple this with things going on around the world. I mean, you don't have to be a genius to say, Europe's in big trouble. I mean, a lot of these places are really in terrible trouble. Russia's in trouble. Greece is in trouble. Spain is in trouble. France is in trouble. Italy's in trouble. Our friends in Canada, they're starting to have some trouble because of this oil. So there's a lot of red flags going around the world. So what we want to do is let's get conservative. And, you talk to a good broker anywhere near where you're at. You should have some very good properties that you can buy, that you can rent. We have sweet spots. So we want to ascertain what that sweet spot is. We want to know what 60 or 70% of the rental population is going to be looking for that price range to lease in, and you want to buy some of those properties. And, of course, we want to make sure that we can get a cash flow off that. Still, again, I'm recommending strategic properties, and strategic property means a good quality cash flowing property that you're going to be proud to own. And we're going to want to look at these for holding a minimum of 5 years. So that income is going to be your lifeboat. I'm looking for you to try and get your cash out of the market into something that's going to be conservative. 5 years from now, I think we have an explosive marketplace. My personal forecast would be, I think we go through a little bit of deflation. I think that you have some severe market contractions coming. You don't want to get caught in that. And then I think that we're going to have inflation coming down the line to pay whatever is left after it gets contracted. So to pay off all this debt, I think we inflate. But I don't think we do that for a while, but we will be coming. So I think deflation first, and then we have some inflation. And by 4 or 5 years from now, we're just off to the races. And here in Phoenix, my investors will be positioned beautifully. We have lots and lots of growth potential here. The sky's the limit. I mean, here we're in the number 2 window in the nation. So, but we're not going to be immune. So we're going to become income investors and be concerned about how much money do I have coming in each and every month. And we're going to want to grow that income, and we're going to be very jealous of our portfolio and make sure that we get conservative. So you're welcome to call me anytime, as you always do. You're welcome to call, and we can brainstorm. You can tell me if I'm right or I'm wrong. You can give me your thoughts. I always love that. So my very best to you. We'll talk to you later. Thank you much. Bye-bye now.